Hi, there is a lot going on in the economy today and in the markets, and sometimes it's just hard to know how to break it all down and understand what is going on. So I'm going to help you a little bit today. My name is Teri, and you're watching the Modest Economist channel. So one of the things that we've been witnessing and hearing a lot about is the Fed raising rates. They started raising rates a couple of meetings ago, but in this last week, they raised interest rates, or I should say, an interest rate, I'm going to tell you what that is, up 75 basis points, so 0.75%. What the Fed is actually doing is not raising rates across the board. They're not raising mortgage lending rates. They're not raising credit card interest rates. What they are doing is raising one rate, which is called the overnight lending rate. And that is the rate that banks basically borrow from each other. What happens when they do this, it's like pulling a lever, is that lever and that rate increase starts to feed through to the rest of the economy. And so there's no direct link between the Fed raising rates and the other big issue right now is inflation. So that's where it gets a little bit dicey, because we have to understand that just because the Fed is raising rates, it doesn't mean that inflation is going to come down automatically. Now, you know this if you've been to the gas station recently, that despite the increase in interest rates, gas is still high. There are just some things the Fed can't fix. They're responsible for monetary policy, not necessarily all the supply and demand. So why is the Fed raising rates, and how will that hopefully impact inflation? The reason that they're raising rates is to slow the economy. Now, we've been through an incredible 2-year period, something we've never seen before, and it really stems from COVID and not only our economy, but global economies just shutting down overnight. So we put the brakes on our economy and a lot of other economies. What that did was immediately push our economy into a recession. Yes, less than 2 years ago, even though we're talking about it again now. So once that happens, what the Fed did is to start pushing money into the system to try to get people to start spending again so that the economy would recover and start to grow. I mean, that's pretty normal in any economy, that you go through these periods of recession, growth, inflation, and at every stage, the Fed is going to take some action. Their goal is to have inflation around 2%. We're a long way from that today with headline inflation at over 8%. But how does it work? So one of the things that happens when interest rates go up, and you can think about mortgage loans, for example, where now it's much more expensive to borrow money to buy a home. What happens is that people stop spending, or they're actually not able to borrow because interest rates are too high. When people stop spending in our economy, which makes up about 75% of US GDP, that starts to slow the economy. And so what we would expect to see with mortgage rates going up is that housing prices actually start to come down. And that's one way that inflation or inflated home prices will come down to a point where if mortgage rates come down again, people will be able to borrow and homes will be more affordable. The other part in trying to understand this story and the complexity of interest rates and inflation is that it takes time. Again, it's not something that happens overnight. What we don't know is how long it's going to take. What we do know is that this is a period that we have of time that we've never seen before, because we've never been through a global pandemic. And so just as the economy started to rebound very, very quickly and then started to slow down very quickly, this is uncharted territory. And I can tell you that no one, not the best economists in the world, not the Treasury Department, were able to predict what was going to happen to the markets, the stock market, to inflation, to growth, to unemployment, when there was an enforced shutdown of the economy. So in terms of investing and the markets, what I'm going to say is that it's a good time to be patient, and it's a good time to look for opportunities, because at some point the economy will rebound, stock prices will come back, and just like March of 2020, when a lot of people stepped into the markets and started buying stock, even though the market is off today, it still hasn't gone back to those levels. And so people who did invest in March of 2020 still have gains. Not as much as they had before, but again, we've had 3 solid years of very high returns, and that has benefited most investors. So hang in there, and I'm going to talk about this a little bit more in a little bit more detail, but the point to remember is this, that raising interest rates does not immediately impact the inflation rate. So if you were expecting that the last 75 basis point increase was all of a sudden going to lower your grocery bill, lower your gas bill, lower anything else where you've suffered from this very quick and rapid inflation, it just doesn't happen that fast. In the next few months, we will see some resolution. Thanks for joining me today at themodesteconomist.com. If you're interested in reading any of my articles, I just wrote one called What's Up with the Markets. Not much, we know. Please go to themodesteconomist.com. I should know the name of my own company, themodesteconomist.com website. Thanks again.